Bring in an expert to talk about these numbers, what they mean to the Canadian economy, what they could mean to the Bank of Canada. Robert Kavcic is our guest. He's senior economist at BMO Capital Markets. Robert, thanks a lot for joining us. What do you think of these retail sales numbers? The tone is that they are weaker than expected.
Yeah, and not a huge surprise on our part. We were looking for a bit of a decline in the month. And when you look at it across the whole spectrum of data for March in Canada, it's not a great picture, right? We had manufacturing volumes down, we had wholesale volumes down, hours worked in the economy were down. So not a big surprise that we kind of round out this run of March data on a weak spot here. And when you add it all up, it looks like the economy really struggled to even hold flat in the month. We suspect maybe there's a little bit of downside risk to that initial estimate that the economy was flat in March. And it's not a great handoff as we go into the second quarter. So we suspect growth is going to cool off a little bit through Q2 and Q3.
Is there a handoff here to inflation numbers? Now, these are March numbers we're talking about, obviously.
Well, the inflation numbers have been really encouraging. That's the bright spot here. The Bank of Canada has now seen a good 3 or 4 months where inflation has really melted down on a core basis. And with that in mind, I mean, the pivot point here is that we could be at the point now once we get to June, if not June, then July, where the Bank of Canada can start taking some of the tightening out of the system and eventually set us up for better growth as we get towards the end of the year into 2025. But the next couple of months look like we're still going to be facing some headwinds from all of that past tightening that's been pushed into the system.
Robert, let me ask you a question. When you look at the drop in oil prices, which is filtering through to the gas pump, and also offsetting that, the Canadians renewing their mortgages, how do those two things come into play going forward for the rest of the year in terms of consumer spending?
Yeah, it's a good question, and especially on mortgage renewals, because this is a big, almost structural headwind that's going to be leaning against the economy for a number of years still going forward, right? So remember all of the mortgages that were taken out down around 1.5% at the peak of the housing market in 2021, early 22. Those are still a couple of years away from resetting. So we have a pretty significant headwind where mortgage payments are going to be ratcheting up, depending on the borrower, 25, 35, 50% from an initial level. So our view on this all along has not really changed. It's been that this is not something that's going to completely break the economy or cause a lot of distress in the mortgage market itself, but it's going to be a big headwind on discretionary spending, right? And the first thing a household is going to do is they're going to pay their mortgage, but what they might also do is maybe take one less vacation or buy buy fewer discretionary goods. And that's actually what we see across the economy now, where discretionary spending has really stabilized. It's held flat in real terms, and that's when we have a population that's exploding 3.5% per year. So that's pretty telling right now that at the individual household level, there is some scaling back of discretionary spending already.
The one number I should have mentioned earlier, and I have not until now, is that StatsCan has, as he often does, provided a so-called flash estimate for April. It says that receipts for retailers, the value of retail sales in April actually jumped by 0.7% from March. That would be the fastest pace of growth since September, but it does note that retail sales are still below levels seen in December. So what do we make of that April number, if that holds the next time that StatsCan reports retail sales? Just a blip in a downward trend?
Well, yeah, you got to keep in mind here, if we're being realistic, these numbers do bounce around a lot, right? So with that in mind, I would say it's good news that we're not seeing momentum get worse into the second quarter. Look at the employment report as another example. We had a pretty tough jobs report in March. Hours were down. Flip that over to April, and we had a big rebound, and actually hours were up pretty strongly. So that's kind of good news that the economy is not breaking, but I suspect there still will be a little bit less momentum as we go through the second quarter.
Okay, let's get to the Bank of Canada. You believe the Bank of Canada is in a position to cut its benchmark rate in June. Do you believe it will do so?
We do, and that's frankly been our call for a long while. So go back 6 to 8 months when the market was pricing in early and aggressive rate cuts from the Bank of Canada and from the Fed too. I think our position all along has been, no, we're going to see central banks hold off at least until the middle of the year. So I think at this point we're sticking to our long-standing call here that the bank is going to cut rates in June. And the evidence on the ground is sufficient in my mind. I mean, we've seen growth kind of slow down below potential, but more importantly, we've seen enough progress on inflation where if you look at core inflation trends over the last 3 and 6 months, regardless of the measure that you want to look at, and we know the Bank of Canada looks at about 3 or 4 of them, we've seen those inflation trends really melt down below the 2% target. So, the Bank of Canada has communicated pretty clearly on this too, in saying that they've seen enough progress on inflation. They just kind of want to see it stick around a little bit longer. And I suspect now that we've seen 3, 4, maybe 5 months of it, that should be enough for the bank to say, okay, inflation trends are encouraging enough. We can take some of the really aggressive tightening off the table at this point. So June is still our call.
And we're almost out of time, but if you're correct and the bank does cut its benchmark rate on June the 5th, what does it do on July 24th? Cut again or hold?
Well, so there's a lot of debate about June or July as the kind of the first rate cut per se, and the market's roughly 50-50 on that. I think following it up really quickly is going to be tough. And our official view here, we see 75 basis points of easing in the second half of this year, but that kind of gets spread out through September and December. And one of the challenges the bank is going to have is that we're seeing much different trends south of the border with respect to inflation and where Federal Reserve expectations are, right? So inflation has been very sticky. Expectations for Fed easing have been pushed out and they've been reduced. So against that backdrop, I think if the Bank of Canada does come out and cut rates in June, they're going to have to be pretty careful with their communication, not to get pricing in the market too ahead of where the Fed is. And the offshoot of that, of course, is what happens with the Canadian dollar. And if the bank was to come out and quickly guide to another follow-up rate cut, you could get pricing a little bit out of whack. That does sink the currency, and then longer term that starts to have more inflationary implications again. So short answer is we don't see a follow-up move at this point, but I think there is a case to see 75 beeps by the end of the year.